Okay, so let's just jump right in. Have you ever looked at the stock market and just thought, this feels a lot like a giant casino? It's not just you. For a ton of people, investing feels exactly like that. Like you're placing a bet against a house that's just built to win. But what if I told you there's a way to flip the script, to win a game that feels totally rigged?
Right. You've heard this a million times about casinos, right? The house always has an edge. It's just a simple mathematical advantage that, over the long run, guarantees they come out on top. And it turns out the stock market can feel exactly the same for most of us regular investors. So that leads to the big question. In the world of stocks, who exactly is the house?
Well, in this analogy, the casino is played by these massive financial firms. The big names with skyscrapers. They've got the supercomputers, the armies of analysts, the split-second trading advantages. They pretty much have the game set up so the odds are stacked against the little guy right from the start.
Now, here's where it gets kind of interesting. We're not going to learn how to win this game by studying the Wall Street geniuses. No, we're actually going to learn from the people who lose. It's funny, but investing is one of those things where the most powerful lessons come from really understanding the people who get it completely, catastrophically wrong. So let's meet our cautionary tale, the emotional gambler. We all know someone like this. This is the person who puts their entire life savings into a trading app, bets it all on one or two super risky stocks, and then basically straps themselves into an emotional roller coaster. They're always convinced that huge profits are just around the corner, like next quarter for sure. And they'll even build these complicated spreadsheets, not to find the truth, but just to prove to themselves that the huge bet they already made was a brilliant move. And for this person, there are really only two ways this story ends. Let's look at the first path. They actually get lucky. Bam, they double their money. Amazing, right? But that rush is addictive, so they try to do it again, and they lose everything. Okay, now look at the other path. They just lose big, right out of the gate. They're down 80%. In a panic, they throw their last 20% at another long shot, trying to win it all back, and poof, it's all gone. See? Getting lucky and getting unlucky, they both lead to the exact same place, zero. So, this begs a really fascinating question. When you see someone who's up 100% and someone who's down 100%, what's the real difference between them? Is one person just smarter? Do they have some secret skill the other one doesn't? The answer is neither. It has almost nothing to do with skill or intelligence. The only meaningful difference is which four-letter stock ticker they happen to throw their money at. It's literally the same as putting all your chips on red at the roulette table. If you win, you're not a genius. You just got lucky that one time. Okay, that all sounds pretty grim, I know. But here's the good news. You don't have to play that game. You don't have to be that gambler, sweating every tiny market dip. There is a calmer, a safer, and a much more predictable way to do this. And the person who really pioneered this whole approach is John C. Bogle, the guy who founded Vanguard. And just look at this number. By inventing low-cost funds, it's estimated he saved investors $1 trillion in fees. $1 trillion. That's money that went into people's retirements instead of into the casino's pockets. His whole philosophy is the key. And that philosophy is called passive investing. And honestly, it's beautiful because it's so simple. Instead of trying to be a genius stock picker, you just adopt a long-term strategy. You buy and hold a diversified portfolio, basically one that's designed to just copy what a broad market index, like the S&P 500 is doing. You just own a little slice of everything. And this gets to a really important idea, the difference between the best investment and the optimal one. The best investment would have been, buying Dogecoin in 2020. It's a pure lottery ticket that paid off, but you can't plan for that. The goal isn't to find the lottery ticket. The goal is to find the optimal investment, something with high expected returns and relatively low risk, based on decades of actual data and math. And believe it or not, this is what that optimal portfolio looks like for most people. It's this simple, a combination of just 3 funds, one that buys you the entire US stock market, one that gets you the entire international stock market, and a bond fund to kind of smooth out the ride. That's it, the whole shebang. So you might be asking, okay, but why stocks? They're risky. And you're right, but it's all about this risk and reward trade-off. Cash is super safe, but inflation just eats it for lunch. Bonds give you a little more return for a little more risk. But historically, stocks have given us the best bang for our buck. The US market has returned about 10% a year over the long haul. That is the engine that's going to grow your money. So how do these total market funds even work? Let's break it down. The main feature is ownership.
With one click, you own a tiny piece of thousands of different companies. The benefit is huge. You're not betting on one company to succeed. You're capturing the growth of the entire economy. But my favorite part is the psychology. When you own everything, it becomes so much harder to panic and sell just because one little corner of the market is having a bad day.
So we can boil this whole winning strategy down to just 4 simple steps. Step 1, own the entire market, both here in the US and internationally. 2, add some bonds for protection. 3, and this is crucial, keep your fees crazy low. I mean, as low as you can possibly get them. And 4, the most important step of all, let time do the work. Just sit back and let it compound. You know, the stock market is predictable in a weird way. Some people are always going to try to beat it and lose, while other people will just kind of set it and forget it and end up outperforming almost everyone. That's why your goal shouldn't be to become a frantic day trader. Your goal is to be the calm, quiet investor who makes those day traders absolutely furious with your simple, steady success.
So, at the end of the day, it all comes down to this one question. When it comes to your money, are you going to keep playing their game, making bets in a casino that is rigged against you? Or are you ready to stop playing and just own the whole casino instead?